If you had to rank
All right.
your favorite liquors in the winter months, what would it be?
Like just by type, not by brand.
Yeah, by type. If you say tequila first, I'm going to slap you in the face.
I
Just
would
saying.
not say that. Tequila doesn't even get to be first in the summer.
Ooh, shots fired.
No, probably right off the bat, probably Scotch, just because it's
Man,
easier.
you're a good man.
2 is rye.
Also a good
Because it
man.
bites.
Yes.
3 is
We are currently in lockstep.
dark rum.
Okay, now you lost me.
Yeah, but it's because 3 is bourbon for you.
Well,
4 for me is bourbon.
No, 3 for me is actually Irish whiskey.
Oh, Irish whiskey is where you're gonna
Yes.
slide that in.
Yeah.
But what I love about
rum, huh?
a dark rum is so high because it can also go in warm drinks.
Well, I mean, so can Irish whiskey. I mean, you make an Irish coffee in the morning. What do you know?
I don't know.
What's just saying, you know? Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, 2 bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. And welcome back to yet another presentation, another episode of Drunkenomics. This is the drinking podcast with an economics problem. So glad you all can be here. Hopefully you have a stiff one in front of you. And just so you know, to wrap up the conversation, James, about rum, one thing I do appreciate a lot about rum is bang for buck, it is literally one of the best liquors on the planet.
It's one where I think
Bang
with
for buck.
rum, unless someone's very, very like, I don't like sugar.
Yeah.
You put it into any drink and someone will be like, oh, okay.
And you can mix it up with anything. It cocktails very well. It's an excellent drink. So I will give you that. Since it's your number 3 winter drink, rum, you can also be the more gracious host. Since we're still, the VIX is
That okay? That's what we'll do.
Yes,
It has nothing to do with the VIX, just rum.
Well, I mean, the VIX is also at 25 today. It closed at 25 today, which for some reason, why the markets went up? Everything went up, right?
I don't know. Maybe people are trying to.
Yeah. Okay. Maybe
we got news this week, so
yeah. No. Okay. Maybe so. Markets did go up. Bond markets didn't go up. Right. Yields went up. So maybe I don't know. The VIX is up like 10% today. So
I think it's you're about to see people are yield went up because people are selling out of bonds. They're going into something else, trying to ride a wave through the next few days, and then when interest rates are announced and. There's no way they can't be 75 at this point if they intend any credibility.
We'll see. But I mean that's the
cycle right back into newer, better bonds at that point.
Yeah, I mean, but I guess that's kind of like the big news heading of this week in America is just big Fed week this week. CPI comes out tomorrow. Today is currently Monday. CPI comes out tomorrow. So today is Monday, December 12th. None of this is financial advice, just in case you guys are wondering. Views don't reflect the views and thoughts of our employers.
Or if they do, it's entirely coincidental. We're not speaking for them. We're speaking for ourselves.
Yeah, exactly. Even if it's like, even if they also think rum is the bang for buck best liquor on the planet, it's entirely coincidental.
Even if they're also rye guys.
Especially in December. Even if that happens to be true, entirely coincidental, but not financial advice. Dude, I just think it's weird. This is a really weird market.
It's putting it mildly.
Yeah, the flirtation of 50 basis points, I think now doesn't, with the jobs report, like we mentioned last week, doesn't carry any merit. But we'll see. We'll see what happens tomorrow.
Reason.
Tomorrow morning.
Yeah, who knows? If CPI data is somewhere else, then maybe it's just okay. Mm-hmm. Maybe jobs are just going to be a thing that's doing weird shit for a while. Weird shit for a while.
Yeah,
who knows?
But also, I think
we'll see.
Yeah, but also, I think we're also looking maybe at Iran, right? Because of all the protests going on there, which is a follow up of a story that we've been talking about for a long time. So, what's the latest in Iran? What's going on over there?
So they executed another protester. So they've executed their second protester since the protest started. So. This led to increased protests, or at least snap protests in several cities.
Snap protests.
Smaller on scale because they weren't planned. But this comes on the heels of last week having general strikes throughout Iran.
Gotcha.
And it seemed that at this point, I've read a lot of stuff that suggests that Iran really is kind of at a point where, there's 2 options most likely going forward. There's more like three options, which is to say, right? Because in economics, we always know you do A, you do B, or you do nothing, and doing nothing is a choice. It's
absolutely
a
choice.
Yeah. It's just may not be the good one.
But sometimes it can be. Sometimes you never know. Like
sometimes it's the right choice is to do neither A nor B. But the general consensus I'm reading is that I'm seeing is that Iran seems like it's on course for either a civil war or a revolution.
Right. Yeah. So that's
each comes with economic pros and cons, right?
Yeah. So I mean, obviously, like this is a much bigger issue than economics. I think it's a humanitarian issue.
Absolutely, because there's people involved. Well, there's always people involved, but very specifically, there's a specific group of people involved and
that are being somewhat oppressed, right? That can't, that aren't entirely free. And it's weird because you talked about Snap protests. Is that what you said? So Snap protests. So it's like the Flashdance version of a protest. Like everybody, like, hey, let's go right now. Like if you're available, let's go right now. And apparently that's been gathering a lot of momentum in Iran, which is not good. And then, of course, the strikes, right, are still continuing. They're ongoing.
Absolutely.
It's even rolled into
other protests. Yeah,
a ton of other things, right? So strikes, not good for production output, the lack thereof, actually, I would say, it has been one of the key drivers of inflation. I think we can all agree on that, right? It's causing supply shortages, quote unquote, even supply chain issues.
Oh, yeah.
Stuff, diesel shortage.
In the U.S., the railroad goes on strike and suddenly you've got a very serious issue.
Yeah.
Truckers go on strike, factories go on strike. If some leg goes on strike, you've got a problem.
Yeah, it's a rough situation it's a sensitive subject really to think about and talk about. We're trying to tiptoe around it, just trying to bring out the economic.
Yeah, I mean, the least desirable. I mean, you could say that, generally speaking, the most obviously least desirable would be civil war.
Yes,
because
that sounds awful.
It's bad. It leads to instability of both economic and political. Actually, it leads to instability in what's already a pretty unstable part of the globe. A revolution would be, revolution is either desirable or not desirable. But for other people, depending on what comes after.
Yeah.
Entirely on what comes after.
But also, like, the process is never, I mean, it's not smooth. Revolutions are rough, right? Like, it's lives being lost.
The U.S. revolution took quite some
it takes
some time.
Yeah.
It could be, let's put it this way.
Yeah.
If they return to being a democratic state like they were in the 50s, maybe this time the West will stay out of it and not overthrow their government in favor of a dictator that was in favor of the West. Right?
Exactly. Well, I think like economical, what people should be caring about or what people should be hoping for is just like, okay, can trade be pretty much free? Like, can there be like a free, not uninterrupted market, but like a free-ish market with certain boundaries that don't necessarily infringe on your your ability to do good business.
Yeah. Can we get equitable trade between two states?
Exactly.
Because obviously that's desirable. Equitable trade means that you don't go to war with people that you have business relationships with generally.
Right.
Positive business relationships with, I should say.
And speaking of positive business relationships, I guess we can touch on this real quick. Sam Bankman-Fried.
Positive might be a strong word.
Exactly.
That's true.
But I think it's
so trending in
the correct direction. That's all I'm saying. It's trending in the correct direction. But anyways, finish your thought.
As of 7 p.m. Eastern time, what is this, 12 December, Sam Bankman-Fried is in the custody of the Bahamian police. So a sealed indictment was filed in the southern. My understanding is the Southern District of New York because that's what has Wall Street.
It's usually,
and because of that means that all financial crimes affect the Southern District, so the Southern District gets the right to go after it.
So what were the criminal charges again? It was like wire fraud.
So wire fraud, conspiracy to wire fraud,
money laundering,
securities fraud, conspiracy to securities fraud, and money laundering are the 5 charges that look like they have been revealed.
Wow.
There will be more. But there will be more.
Well, I just remember I saw this one tweet from what's Douglas Boneparth. I love this Twitter page. He's hilarious. But he tweeted out saying Sam Bankman-Fried to post bail using FTX token.
He doesn't have enough. Let's put it that way. He doesn't have enough. Even with all of them, he doesn't have enough. Somehow these went negative. He owes us more money. I don't know how this happened.
Yeah, well, I just thought it was funny because last week I think a lot of people have been like kind of wondering what's going to happen. A lot of people have been watching it, and and Maxine Waters came out and started talking about him.
Well, that's because Maxine Waters.
Yeah,
she didn't know that the Department of U.S. Attorney was filing charges. They did not tell Congress.
Why would they?
They shouldn't. You do not read the committee that oversees you in on every single prosecution you're going to take. Especially if, and I'll be honest, politicians, unfortunately, like Fed bank chairs, have loose lips.
Well, again, that's the thing. It's like the last thing I want is for the FBI to do an investigation on someone, and all of a sudden one of their Congress lobbyist buddies goes, "Hey, they're doing an investigation on you, so delete your emails."
Yeah,
right?
Dude,
like I don't want that to happen.
Yeah, do something. So, they're looking, and then the next thing you know is Sam Bankman-Fried's in the wind. But
right, yeah, I just figured why not talk about it? It's newsworthy, right? I don't know. I haven't looked at.
He's in custody.
Yeah, I haven't looked at crypto. I think it's taken a dump right now. I have no idea.
Probably
I haven't looked at crypto.
It has been all year. Having said that. And this is on a slightly more, and I think I unfortunately haven't said too much, but if you want to keep up with some of our other outrageous outbursts and more entertaining opinions, especially in real time when they're happening, check us out in the metaverse and on Twitter at Drunken Uncle, Drunkenomical, DRUNKENOMICAL.
There we go.
Also, jump into the Discord. We hop in there every now and again. I'm going to be down for the next week, not really jumping in. But it's going to be a great place for you to keep in touch over the Christmas weekend. So between Christmas and the New Year, we're going to take the week off and get healthy, eat right, go to the gym, just really be sober. Oh, what the fuck am I talking about? The other gym I go to is Jim Beam.
Yeah, I was going to say.
We're going to go out and have some fun.
Jim, what do you mean, Jim? We're just going to, that week might just be too hungover is all I'm going to say.
No, we're going to have some fun. So take that week off, make good choices, stay Drunkenomical with us. But if you want to keep up with us, we'll be popping in and out of the Discord. We'll be there for conversation. We just won't be here wherever this is for you.
Yeah, just on that week, we're going to take that week off and just kind of chill out. But I guess about our Discord, one of the things we've been talking a lot about is options or our options, whatever. Like a lot of people have been asking about, how to do certain option strategies. So we're about to go into a subject that's a little bit confusing. It's advanced
option strategies, right?
It's advanced options trading strategies. So, and we promised to talk about it last week. This week we're breaking up our episode in half, right? So,
so this is options part 2. Part 1 out of 2 of this week.
For this week. Yeah.
All right.
Because Wednesday we're going to talk about the Fed stuff and CPI and just kind of react to that. Just a short one there. But
which means you'll be hearing from us on Thursday. But at the normal time.
One, just to kind of follow up on last week's episode, where we kind of did like a general overview on single leg options trades. This one, complex option trades. So anytime there's an options strategy that involves more than one options contract,
it becomes a strategy.
Yeah. And believe me, the more you think about it, if you have any questions, feel free to jump on our Discord, slide in our DMs, hit us up on LinkedIn, whatever it is.
Absolutely.
I love talking options. So if you have any questions, feel free to just hit us up anytime.
Which is funny because I love talking accounting, it's very
It is odd. I feel like you're the accountant and I'm the trader.
It's very odd. It's funny how nature do that.
Yeah, no, it's really weird. But anyways, I don't know. Where should we start? Should we just start by talking about protective puts and just kind of ride the wave and see what happens?
Yeah, I think that's a pretty good place to start.
Okay. Yeah, fair enough. Well, protective put. Essentially,
it does have one other name. So like a protective put, which is what Aaron calls it. And when I took classes where we talked about this, so my finance classes, it was always called a married put.
Yeah,
by my instructors.
Yeah, I don't like calling it a married put just because I don't know. Marriage sounds like a really big commitment. That's why.
Whereas options can be exercised at any time.
Exactly. So
in the U.S., right?
Yeah,
last week.
Yeah, I'm just saying that, and I'm not trying to scoff at marriage. It's a big deal, right? So but this is an options contract. That's all I'm trying to say. You want to protect yourself, in some way.
Yeah, there's an expiration date on every option you've ever gotten.
Yeah, exactly.
Hopefully not on a marriage.
Hopefully not, right? So protective put, essentially, what is a protective put? Let's say you buy 100 shares of a stock at $100 and you're scared that you didn't buy it at its lowest point and you think it's going to sink some more. So you're like, oh man, how can I protect myself if it does sink within the next 30 days? Well, what you can do is you can buy a put option with a 30-day expiration. So if you buy the stock for $100, you can also buy a put option for like $99. And essentially what that does is that secures your right to sell your 100 shares of stock that you just bought for $100. It secures your right to sell it for $99. So if it falls to $80, you can still sell it for $99 because you have the right to sell it for $99.
Yeah.
Right?
So it's essentially it just limits your downside risk.
Yep.
And from a longer perspective is if you bought at 100 on all your shares and then you sold at 99 because it gets down to 89, you buy again at 92. you've gotten your position back.
Yeah.
But you've also gained back that difference in security price versus
right. Yeah, exactly.
Whatever premium you were paying to secure those rights or brokerage fees.
Yeah. Well, I mean, usually it's just a premium.
Yeah,
so like whatever it trades at. And, and I kind of like, just in case you guys are wondering, like I did, I don't know if anybody's seen like an options chain before, but I did post a screenshot in our general Discord chat. So, it's just a screenshot of Thinkorswim, just the standard options chain. I forget what stock I put up in there, but I think it's GameStop. But yeah, it's a standard options chain. You'll see the puts on the right side, right? So in this scenario, GameStop is trading, just on the screenshot, GameStop is trading at 23.09. Let's say you bought it at 23.09. You're scared that it's going to fall to $15.
20.
So you can buy the 23 strike put for 150. Just looking at the bid ask spread, right? Like, wow, that's a really wide bid ask spread. But whatever, you can buy for around that price. So you pay $2 to secure your right to sell for $23. In the event that it does drop to $15, you can still sell for $23 since you have that put option. To kind of like go on the other side of a protective put. A lot of people are like, well, what if I don't want to pay $2 for this put option? What if I don't have $200 to just throw out this options contract? Well, then what you can do is you can do a collar, right? So it's kind of like a married put, protective put, but what you're doing to pay for the put option, to find the $2 to pay for that 23 strike put is you sell a covered call. So you can sell if you buy 100 shares of GameStop for 23.09, you can sell the 24 strike calls for 150-ish. It looks like on the options chain, it's around 150. Let's just round up to 150. You can sell it. You can sell a 24 strike call for 150. And use that to pay for most of the put option that you see, that the 23 strike put that's trading at about $2, right? So really, like you're really only, if you think about it, paying 50 cents for that 23 strike put, because you're spending $2, but you're also receiving 150 from the call. So you're selling covered call for one. So
you're selling a call.
Yeah, exactly. So you're buying the stock, and then from there, you're selling a covered call for $1.50. So you're receiving $150 from that covered call, and then you take that 150 and you spend it on a put option plus $50 of your own money to pay for that the $2 strike.
The $2 premium.
Yeah,
that's on your $99.
Oh yeah, on the $23
married put.
Yeah. So
he's covered call with a married put.
Yeah. So that's a collar, right? I know it sounds confusing, but I guess the reason why we broke this week up into two parts is because if advanced options trading is not something you're interested in, I guess you can just kind of tune us out and just tune back in on Wednesday after.
Yeah. This is we try not to go into overly complex topics, we try to rather simplify them to a very common language. And the problem is when you're dealing with advanced option strategies, advanced trading strategies, you do necessarily have to kind of go like, yeah, there's like 20 of these. It's like explaining football and then explaining plays.
Yeah. It's like,
right?
What is
he's gonna try and run the ball?
Yeah, versus
this is a quarterback sneak.
Or it's like explain coverages. What does Tampa 2 mean, right, for football? Like, I mean, if there's a football player out there, they're like, well, obviously, but whatever. Like, it's kind of like that, right? So like, a collar is essentially just like you're limiting your upside, right? So like in this scenario that I just drew out for you earlier, where you buy the stock at 23.09, sell a 24 strike call, buy the 23 strike put, you're limiting your downside for the duration of the contract. You're limiting your downside loss, right? So you can only lose
$1
or whatever. Yeah, 9 cents minus 50 cents. So, or I guess -9 minus -50, right? So you can lose 59 cents in this scenario, but you stand to profit. Since you spent, just doing, napkin math here, you spent 23.09 on the stock, you spent another 50 cents on the collar. The max profit is if you sell the stock for $24 because of the covered call. The covered call at 24 means, from now until expiration, if the stock goes up to $100, you still have to sell it for $24 to honor the contract, to honor the short side of the contract. So in that scenario, 23.09, 50 cents. So your cost basis is technically $23.59. So that gives you really a 41 cent per share profit. So $41 in this case is your max profit potential. And then, of course, like I said, on the other side of that, your max loss potential, since your cost basis is $23.59, the lowest you can sell it for is $23, even if it goes down to $10. So the cost basis is $23.59. Your max loss potential is $59, right? So I mean, I don't know. Like in this scenario, I wouldn't consider that a good trade. That's just me, right? Because your max loss potential is $59, but that's just this scenario. I don't necessarily think married puts are a bad idea.
Yeah,
especially
the entire premise of the covered call is that the covered call is a method to fund against a potential loss, right? So it's I have a fear that this might occur. Yep. I don't necessarily want to spend all my capital to protect against that. So I'll sell against the upside. And there are times where you can sell a covered call that will pay out more than your. Oh yeah, you could make more money doing that than you're spending on on your protection on your married put. And it's possible.
Oh yeah, definitely possible.
If you were to somehow do that and then make more money than that, and if you're right in that the stock price does go down, then you can sell your position, buy back in at a lower price, and have made more money than otherwise. But it's also possible that if the stock goes the other way and it accrues value and shows gain, that you could have, you'll have to be willing to sell at that price when you sell the covered call, because that's how that works. But you sell at that price, then you go, well, I've still made money. I just had a cap on my gain, in the same way you had a cap on your loss.
Exactly. And that's the thing is, like, so I'm a huge fan of covered calls because I think it's a great way to lower your cost basis for stocks that you're buying, right? So if you buy 100 shares of blank stock for $100 and you sell a covered call for $5, you essentially are really only paying $95 for the stock. So that's why I love covered calls. But the downside for covered calls, the biggest downside for a covered call is you have to hold the stock all the way until the expiration of the option.
Absolutely.
Which is rough because if the stock goes to, like, if you buy stock for $100, sell a covered call for $5, right? And let's say that covered call goes out till, 2 months from now, but from now until 2 months from now, the stock goes to $80, that's going to hurt, right? That's going to hurt a lot. Mm-hmm. So that's the biggest downside of a covered call. The other big downside is you're capping out your max profit. So let's say I buy stock for $100, I sell a covered call for $5, and let's just say, for easy math, let's just do 105, right? The covered call strike price is 105, right? That means even if the stock goes up to $120, I still have to honor my short call position and sell the stock for 105. And it's happened to me before, right? Like at one point I did buy stock and I sold a cover call against it, and the stock just continued to shoot up. And it was a stock that was around $15. I sold the 1550 cover calls. So I received $1.50 for it, and the stock went up to like $24. And I wasn't able to realize that profit because the stock got called away at $15.50, right? So that's another big downside. Yeah. And but don't get me wrong, like I've been on the other side of that too, where I sold the cover call and the stock just kept going down, right? So I've been on both sides. It's not fun, right?
Yeah, you want to be on the right side of it every time, but that's investing.
Yeah, in general. Yeah, it really is. So like cover call, like if you want to look for a trading strategy, I mean, I don't know, like I personally would look for something with a lot of implied volatility. If you're trying to pick a call that you want to sell, personally, I would. But granted, there's a lot of uncertainty with that too. So it just depends. But ideally, theta decay is something that you want to eat away at. So try to sell a cover call with a little bit more theta, or a little bit more negative theta, I should say, and something with maybe a little bit of vega as well. Ideally, right? But it also depends. If you really want to hold on to the stock, you just got to shoot for something that's out of the money with low delta.
Well, yeah, but you can also cover a call with a calendar. If you really want to play, you can do a calendar spread.
Yeah,
which is quite a few of these are just spreads.
Yeah, So calendar, essentially a long calendar. So if you buy an option with 60 days to expiration, and then you short the I don't know, like a 17 days to expiration option, right? So you shorted one that's pretty close to expiring, and then you bought one that's gonna expire 2 months from now, right? You can cover the call that way. I personally love calendars. That's just me. Like there've been several times where I've bought a long dated option and shorted options in the near term and let them expire worthless, and have actually made back the premium that I spent on the long calendar on the long option. So I love calendars.
But calendars are just, the big thing is that obviously with most of these option strategies, you deal with options that all expire on the same date with the same underlying security. So yeah, this is critical. This is all under the same underlying security. I guess we should have said that sooner.
Yeah, probably.
But with a calendar, that's when we start to deal with different times, right? Mm-hmm. So you buy on one date and sell on a different one, right? So you would an option. So you'd buy an option on this month and sell an option on for the next month. And then
that would be a short calendar.
Try to capitalize on the changes between the two.
Yeah, so in your scenario, like if you short the one that's further out, that's a short calendar, and then a long calendar is you buy the one that's further out, right? Yeah. So if you buy the one that's further out, that's considered a cover call as well, right? So that call that's longer dated, that's also
that type of cover call.
Yeah. So when you do these calendars, I'll just say this: a lot of times, what people are always worried about, I think, is a pretty common thing. You buy the long dated call, you sell the shorter term call, and you're worried that the shorter term call is going to expire in the money, right? Mm-hmm. So if you're really that worried about that short call, if you're worried about pin risk or that short call expiring in the money, what you have to do is you have to manage this position actively. So you have to roll that short calendar forward, right? And every time you roll it forward, think about what happens. You're adding theta decay, which means you're receiving money, you're receiving cash. So every time you roll it forward, as long as it's the same strike price, odds are you're probably receiving a little bit of cash every time you push back that short calendar a week. So that's something to keep in mind if you are interested in doing calendars. If you want to talk to me about it, I'd be more than happy to kind of like walk you through that. But short calendars, if the short option goes into the money, you got to keep an eye on it. You got to roll it forward.
Yeah, it's essentially it's kind of like musical chairs. You're trying to keep everything rolling.
Yeah,
you're trying to keep everything moving. Yeah. In a way that you're on the right side of, right? So it's
exactly. Like, and of course there's diagonals too. So, calendar is, so I buy the 100 strike call that expires in January. I short the 100 strike call that expires in December. A diagonal is just, you pick a different strike price. I buy the 100 strike call. I short the 95 strike call that expires in December. Right. Or I buy the 100 strike call that expires in January. I short the 105 strike call that expires in December. Right. And essentially, like, what you're trying to do whenever you do these cover call strategies is you're just reducing the cost basis of that long dated call, or you're reducing the cost basis of that stock that you already own. Mm-hmm. So I guess from there, like, since we're on spreads, I guess we can just start going into
bull call, bear put.
Yeah, so let's do bear call, bull put. Right, those are what we call credit spreads. Right, why do we call them credit spreads? Because you're receiving your credit up front. Right, so bull put. So just think about a put options chain. Odds are the higher the strike price, the more expensive the put option is going to be. Makes sense because you're buying the right to sell it at a higher price. Right.
Yeah.
Odds are it's going to be charged a little bit more money. Right. It just makes sense. Right. If you want to buy the right to sell something for $100 versus buying the right to sell that same thing for $80, it just makes sense that you would have to pay more to sell it $100 and at least by $20.
And right? with a bull put option like that, so with a bull put spread, you're sitting on a security you're bullish on. You say, hey, I'm going to sell the right to sell it. I'm going to sell the right to sell at certain or I'm going to sell you the right to buy at a certain price. I'm going to sell you the right to buy, or I'm going to sell the right to buy at a different price. And you're hoping one will not be exercised and the other one will be, essentially. And you're like, well,
actually, for a bull put, like you're hoping both of them.
Oh, you're right. I'm looking at my bull call notes. That's why.
No worries.
Yeah, you're absolutely right. With a bull put, with any kind of with a bull put spread or with any kind of put spread, a credit spread, you want neither to be exercised. You want to be outside of it. Essentially,
you're essentially saying
because you want to collect the premium off both,
exactly,
and not have to make good on either.
Yeah, exactly. So like you're selling the right to sell at, let's just say there's a stock that's at $110, and you sell the right to sell it for $100, and then you buy the right to sell it for $95, right? So you're selling the higher strike put, buying the lower strike put. Since you're selling the higher put, like I mentioned earlier, the higher put
generally pays a better premium.
Yeah, so you're selling that put, you're buying the lower put, right? So you're going to receive a little bit of money for that, probably like $3, depending on where the stock's at, depending on what the deltas are and all that kind of stuff. You're going to receive like $3, and you're just going to kind of hope that the stock stays above $100. So if the stock in the previous example that I said is at $110, if it falls to $100.50, you're still in the clear, right? But it's when that stock goes below $100, that's when you're starting to get worried about it.
Yeah.
Right.
No. So essentially, with these spreads, and I know we've talked about them in the past in an episode, but there's limited upside. There's a limited profit on it, but also limited downside. There's a maximum out-of-pocket risk.
Yeah, exactly.
There's a point where you can sit here and say, like, I can gain $17,000 making this trade, this random trade I'm coming up with, and the most it'll cost me is $1,000 if it goes the other way.
Yeah, I mean, essentially,
So,
the max loss for any sort of credit spread. So bull put, bear call, right? Bear call just means
the other way.
Sell a call.
You expect to go the other direction, go down instead of go up.
Since calls are the opposite, right? The lower strike call, the more expensive it is on the same stock, right? Odds, it just makes sense, right?
Mm-hmm.
So the lower strike call, more money. You sell that one, and then you buy the one above it. You receive a little bit of money because you're selling a lower strike, buying a higher strike call. Worst case scenario for any of these situations, whether it's a bull put or bear call spread, worst case scenario is that both of those options expire in the money, right? So, bull put spread, bull meaning bullish.
Up.
Yeah.
Markets are up, prices up.
Yeah. If the stock isn't feeling bullish and it becomes, and it falls down and both the options are in the money, you're at a max loss, right? So let's just say it's 5 points wide, right? You're selling the 100 strike put, buying the 95. Let's say you receive $3 for it, right? Your max loss potential, since you receive $3, since the width of the spread is $5, your max loss potential is $200. And then of course your max profit potential is what you receive in premium. And all that needs to happen for you to receive or for you to achieve max profit is for both options to expire worthless. That's it.
Yeah, to not be usable.
Yeah.
But those are just two strategies around what's called essentially vertical spreads, which is to say, I'm betting on a price going up or down. That's it.
Yeah, but you also want limited loss potential, limited profit potential. I mean, you don't want limited profit potential.
Sacrifice.
Yeah, but you sacrifice that. It's risk
But
reward.
you put a limit on that for the limited loss.
Yeah.
You limit your profit to get limited loss.
Yeah, and then of course the opposite of that would be the debit spread. Not the opposite, but I guess a similar thing but different.
The other side.
Is a debit spread. Yeah, so you buy the lower strike call, sell the higher strike call. Essentially, all you're doing is you're lowering the cost basis of the lower strike call, right? So you buy the 100 strike call, sell the 105, right? If normally the 100 strike call costs $5, like you're reducing your cost basis because you're selling the 105 call for $1, right? So you're only paying $4 for the 100 strike call. But it's a useful strategy because if you really think that if you're bullish on a stock, right, and you think it's going to go up, but you don't see it going up and above 105, like you see a stock that's at $95 and you don't see it going up and above 105 by the next 30 days, you can just do that, right? You can buy the 100 and sell the 105, and there you go. That'd be the perfect trade if the stock does close exactly at 105 on that day, right?
Yeah, as long as it stays and does what you expect it to or want it to.
Yeah. You're reducing your cost basis, right? Your max profit potential is essentially both options are in the money, right? So, what happens if a short call expires in the money? That means you have to sell the stock at that price. But if you have the right to buy it at a lower price on the same day, right, you could just exercise that right and then turn around and then have, the short call get exercised upon you. And then from there, you're flat. You're not short, you're not long, you're just flat. And in this case, you'd be at max profit. Bear put spreads, kind of the same deal. You buy the 100 strike put, sell a put below that, right? So you're paying a little bit of money to have the right to sell a stock at a certain price, but you're also selling the right to sell at a certain price to reduce your cost basis that you paid for the right to sell it at a higher price. So that's essentially what it is, right? I hope this makes sense. Seriously, if you have any questions, let me know. But I guess, this does segue perfectly into what an iron condor is.
I was going to say the land of the extinct birds or the endangered birds.
Yeah. So I love iron condors. I think they're fantastic. I think it's really a good way to play with time decay and to play with volatility, right? So if you don't think there's going to be a lot of volatility, if you see a stock that's it's pretty close to its 2-week high, but you don't see it going above it, but you also don't see it sinking too much. Right? What happens if a stock just goes sideways? How can you profit off of a stock going sideways?
And the answer is you use kind of two of the above strategies, right? Because an iron condor is simultaneously doing what? A bull put and a bear call, right?
Yeah, that's exactly what it is. No, it's two credit spreads, right? But the benefit of an iron condor is that, if you look at the max loss on a bull put spread and you look at the max loss on a bear call spread, well, what would happen if you combine the two, right? So if you sold an iron condor, if you shorted let's just say there's a stock that's trading at $100 and you shorted the 105 call, bought the 110 call. And on the other side, you shorted the 95 put and you bought the 90 put, right? So you're basically giving the stock a $10 range to trade in between for X amount of days, right?
And as long as, ideally, you're looking at something with extremely low volatility, right? You don't want anything volatile in this because that would not make sense.
Well, but at the same time, like volatility helps you receive premium. But it just depends, right? It really just depends. So like if there's a lot of theta decay, right? If you see like, and you don't have to open these up at the same time, right? Like you don't have to condor, like you don't have to do same time, same trade, right? You can see the stock and it goes up to 105 and you're like, all right, well, there's resistance at 105. So bam, I open up the bear call spread right there. When it's 'cause honestly, right? Like if you sell a bear call spread when the stock is at 104, you're probably going to receive a lot more premium than if you sold the bear call spread, the same exact bear call spread when the stock's at $100.
Yeah.
Yeah. Just because the higher delta, all that kind of stuff. And same with on the other side, right? Like if the stock's at $100 and you want to sell the 95 put, right? You're not going to receive as much money if the stock's at $100 than if the stock is at $96. So if you see a stock trading around this range, so if you see a stock trading around a range, right, between 95 and a 105, and you're like, it's not going to break up above this range or break below this range, and you want to take advantage of it, sell the bear call spread at when the stock is at 105, and sell the bull put spread when the stock is closer to 95, and then there you go. Now you have an iron condor. All you need is for the stock to stay in between the price of 105 and 95. Obviously, there's a lot of risk in this, so it's not like it's not
your
like
downside's almost always greater than your upside.
Yes, absolutely. So, but the thing is, like the thing about iron condor is like only 2 of these can expire in the money, right? So, maximum loss potential is only unidirectional. It's like you can't achieve max loss on both the bull put and bear call spread. It's just not possible, right?
It's you usually end with a net positive premium on it, or you end up in a net positive position on the premium side, right? So you're gonna make money selling it,
but it's also just unidirectional, right? So like you sell an iron condor, you get $2 on one side, you get $2 on the other side. It's a 5-point wide spread. And obviously, like you can choose your own strike prices, right? So you can make it a 10-point wide spread on both sides. You can make it a 10-point wide spread on one side and a 5-point wide spread on one side. It doesn't matter. It's up to you, right? But essentially, like you can only achieve max loss on one side. So like, the stock isn't going to close below $90 and $110 and above $110 at the same time. It can't do that. The stock can't close with all 4 contracts in the money. Like it,
2 of them have to not be.
Yes. Yeah, exactly. At least, right? Ideally, all 4 of them close out of the money, right? And
ideally all 4.
Yeah, but you achieve max profit. You just want the stock to stay in between 95 and 105. But max loss potential, let's say you receive $2 on each side of the spread, right? Your max loss potential is $1. It's the width of the spread minus whatever you receive in premium. That's your max loss potential. And then, of course, your max profit potential is just whatever you receive in premium.
Yeah. So
I know it's confusing, but seriously, any questions, feel free to ask. And then, of course, if you really want to achieve max profit on, low volatility, you can do a straddle or even a short strangle, right? So a strangle is essentially you buy and sell the same strike call and put, right? So you buy 100 strike call, 100 strike put. The advantage of that is as long as there's volatility, as long as the option moves in any direction, you can make a profit. The downside is your cost basis is super high. You're buying a call and a put at the same strike. Very, like I personally only use straddles just to measure volatility, right? Yeah. Just to measure like what people, how much movement people think is going to happen in a stock, right? So I'll look at a straddle quote and see $8, and then it's like, all right.
Yeah, it's because straddles and strangles both just need the market to move up or down. They don't care. It just has to move. It can't. Be stagnant.
Yeah, strangle is essentially you buy a call and you buy a put, different strike prices. Like, in that scenario, you just need the stock to move a lot. And if you short a strangle, it's essentially like think of the iron condor, but you don't spread it off, right? So you're shorting a put and then you're shorting a call. Right? A short strangle is essentially you're shorting a put, shorting a call, and the stock needs to stay in that range because there's unlimited loss potential, and the max profit potential is just whatever you receive in premium. So that's essentially what a short strangle is. I know I've talked forever, and I should probably
that's all good.
Yeah, I should probably just talk about butterflies real quick. Just because I don't like butterflies. I just don't. I'm sorry, James.
Yeah. So the butterfly, the easiest way I kind of like to describe a butterfly is that it's it combines the strategies of a straddle, and it uses bull and bear spreads again. Right.
Yeah. But like a butterfly,
but it uses 3 different strike prices instead of 4.
Yeah, but it's like it's 4 legs, right? So you're shorting, butterfly. There's the body and the wings, right? So there's the, like ideally, what you want to do is you want to buy an in the money option, right? So in the money put, in the money
buy
call.
One in the money.
Yeah, it doesn't matter. But let's just use
you
calls.
Sell 2 at the money, right?
Yeah. So if the stock's at $100, you sell 200 strike calls, buy an 95, and then buy 105. And essentially, like, your max profit is if the stock closes exactly at $100. But if it closes at 101, but if it closes at 101, you're not at max profit. And if it closes at 99, you're not at max profit. So it's like, how do you know it's going to close exactly at $100 on that day?
Yeah. So essentially, the iron butterfly, instead of trying to get things to be outside of a certain zone or inside of a certain zone, you're trying to make it be at a specific point.
So like that's why
to maximize your profit. And
so that's why I don't like it. Right?
It's like roulette.
It's exactly like roulette.
This is all a big game of roulette, but at least like the straddles, the strangles are like, I need it to be red or I need it to not be black are the bets. Whereas the butterfly is like 35.
Yeah, but it's also like, the thing is like, so condors are easy to manage. Straddles are easy to manage. Short straddles are easy to manage. Like, all these strategies are easy to manage, but butterflies are not. Like, if you can receive a net credit somehow for a butterfly, it might be an unbalanced butterfly, right? Unbalanced butterfly just means like, you short the body, the one wing, so you short the 100, 2 100 strike calls. The call above it is 110 and the call below is 98, right? So like, the wings are different sizes. So that's unbalanced butterfly, right? So in that case, maybe you could receive a net credit, and if you do, like, it's not a terrible trade, I don't think, but like, with condors, it's like, okay, there's time decay. So like, if you do an iron condor, if you open an iron condor and 20 days goes by and the stock hasn't moved, you can just buy back the condor and odds are you'll probably make a profit. Right. Or like a calendar spread.
Because it's in a different position. Yeah.
Yeah. Because like, you shorter, it's a credit spread. And then, credit spreads, what do? They take advantage of time decay and vol crush. Right. So over time, volatility decays, time decays, and then you can buy back for a cheaper price. And same with like calendars, like you can roll forward and all that kind of stuff. That's why, like, I like those strategies, but butterflies are just like, when do you? No,
with butterflies, it's like whenever you try to be so exact on a point, I'm like, it's
So that's why
it's like playing darts. It's like
it's exactly like playing darts,
and then there's in a specific cork area of the bullseye, and it's like, nah, this isn't.
Yeah, it's exactly like playing darts.
It doesn't work.
Yeah, so that's why I'm not a huge fan personally. But if that's your thing, if you have an argument for why butterflies are the coolest thing ever, I am all ears.
I'll hear it.
Like, yes, like if you can try and convince me, I would give you the time of day to try and convince me that butterflies are the best thing ever. Best thing since dark rum in December. Ooh, right? Like,
risky.
I mean, convince me, please.
Good luck.
Because I don't get it. I've never done it before. I've never done a butterfly before because I just don't believe in it. That's just me personally. But like, I know a lot of people that have done it. Like, when I was on the trade desk at TD Ameritrade, a lot of people did it. Like a lot of smarter than me options traders did butterflies. So I don't want to discourage you from trying them, but I'm just saying I personally don't do it. That's just not my thing.
Fair.
But you want to know what is my thing is
what your thing is, Aaron, is being drunkonomical, playing chess on checkers, and looking great while doing it.
Yes.
That's what your thing is.
It is absolutely my thing.
And if you also want to do that thing, be drunkonomical, play chess, not checkers, but more importantly, look great while doing it, you should check out drunkonomics.myspreadshop.com, now with the long promised.
Yes, I was going to say, I was so excited about that. I saw that, the Drunkonomics coin looks great.
Able to get a lot of it up.
Yeah, it did. I mean, we finally have our own cryptocurrency, except for it's not real, but it's a logo. So, and it's on shirts, it's on hoodies.
The Drunkonomic coin?
Dude, the Drunkonomic coin, man. I like that. You know what? That's what it is now.
I'm going to go in a little bit. As soon as my computer's back up and running, right, I'm going to go in and I'm going to change the name from Drunk Token or from the Drunkonomics token to Drunkonomic
Coin. I love it. I love it more, man. That's awesome. But yeah, it's on Golf Polos. So if you want to rep us while you break even or shoot 90 or 100, whatever you shoot on the golf course, hopefully it's under 80, but whatever it is, I mean, you can
also get it on, you can get some sweet swag on aprons, hats, hoodies, metal pint glasses so that won't break if you drop it. So you know when you start playing checkers, not chess, which sometimes happens when you're playing too much chess, not checkers.
Dude, too much, way too much,
But that's, it's up. We got some sweet stuff.
From there, if you want to help James recover his computer screen, you can also check us out at patreon.com. That's patreon.com/Drunkonomics. That's, I don't know, essentially our way of selling a cover call that expires out of the money.
Every time, it always expires out of the money. I've got good news and bad news, folks.
Yeah, sorry, but if you want to leave it seriously though, like we really appreciate all this help and support, like, you know, all the drinks that you guys have with us. But if you guys just want to leave a tip in the tip jar, we'd really appreciate it. You can help us do what's that thing?
It's when we keep the liquor cabinet stocked and the ice frozen,
and the fruit fresh, and
the lemon's yellow, the lime's green. Because I don't know if you've noticed this, guys, but if you hold them a little too long, they go brown.
Oh yeah, it's not a good look.
And the juice inside's still fine, but I can't use the peel for garnish. So look, it's
no, exactly. That's what I'm saying. You know, what if I wanted to walk old fashioned for some reason in December? You know, like maybe I do. Maybe I gotta garnish it with a green lime.
Mezcal's smoky. It's kind of like scotch.
Yeah, there you go. Yeah, exactly. So, you know, maybe I'm in the mood for that. But yeah, seriously, all the support there is much appreciated. But seriously, like James said, continue to play chess, not checkers. Continue to fill and kill. Don't brag, just say. But most importantly, what's the thing?
Stay drunkonomical this week?
That's what it is. Thanks, man.
Or at least until Wednesday.
Until Wednesday. Cheers, my friend.
Cheers.